In this video, I am analyzing private banks. These are HDFC, KOTAK, ICICI, Axis and Yes Bank. The data available for HDFC, Axis and Yes Bank is up till 2019, and for KOTAK Mahindra and ICICI we have the TTM balance, that is the 12 trailing months or the latest 4 quarters up till 2019. HDFC's current market price was 2,472 and the fall from its 52-week high or from 1 year back was just 1.2%. Other companies till Axis Bank also had a minimal fall from their 52 weeks high. These companies are at their highest level. Yes Bank has fallen 78% from where it was 1 year back. So here we want the least fall, and that would indicate that the companies are very strong in terms of price. Yes Bank has fallen at 78% from where it was 1 year back, and that means that there is some problem in the company because of which it had such a drastic fall in its price. Let us look at the earnings yield of the company. This measures the profit that the company has earned on each share against the current share price. So the current share price was 2,472 CR and it has earned 77 rupees in the latest 12 months or the last 4 quarters, and that works out to an yield of 3.1%. Kotak has earned 2.5%, that is on a price of 1517 per share. The company has earned a profit of 37 rupees, which translates to 2.5%. The highest earnings yield was seen by Yes Bank at 8.4%. On 88 rupee per share, the earnings earned was 7.4 rupees, which works out to an 8.4% yield. There's a drastic fall in the price of the company in the latest 12 months. Let us look at the price earning of the 12 months. This is the current market price of the company divided by the earnings of the company in the 12 months. That is the current market price divided by the earnings of the 12 months. This ratio helps us understand where the price is compared to the earnings of the company. In other words, we can also say what multiple are we paying, or what is the price we are paying for the earnings of the company. So in this case, HDFC price earning is trading at 31 times, which means that the company was earning 77 rupees per share, and to buy that share the investors were paying 2,472 rupees, which means they were paying 31 times more than the earnings of 77 rupees. So here we want the earnings or the price earnings to be below 25 times, which would mean that for 1 rupee of earning, investors are willing to pay 25 times. Kotak Mahindra's price earning was very high at 40 times. ICICI was trading even higher at 66 times. Axis was trading at 44 times its earning. And Yes Bank was available at just 11 times its earnings. Because the price has fallen drastically from its 52 weeks high as we saw earlier, therefore it is available at a very low price earning multiple. Here we want the price earning to not exceed 25 times. Let us look at the historical 5 years price earning, where the company's average price to earnings ratio was during the last 5 years, and then during the last 3 years where it was trading compared to its earnings. These are all valuation metrics. The 5 years historical price earnings as well as 3 years helps us understand where the price of these companies was trading over the last 5 years and last 3 years on average. And then we can use the current price earning to help us understand where we should enter or where we should be buying the company's shares. Historically, HDFC was trading at 25 and 26 times. So currently at 31 times it is expensive because it's above the 5 years average. Same is the case for Kotak, where it is trading at 40 times its earnings, whereas historically it was 31 and 35 times its earnings. ICICI too is a very high at 66 times. Although the earnings has fallen to 6 rupees per share, the price has not fallen accordingly. Therefore, the price earning is shot up to 66 times. Whereas in Yes Bank, we saw that the price has fallen and the earnings also has fallen. That is why the price earning is at 11 times. Axis Bank's historical price earning was very high at 106 and 141 times. Whereas Yes Bank was trading below 25 times, 19 times in 5 years and 22 times its earnings in the last 3 years. So we want these ratios to be below 25 times and the latest price earning to be just not below 25 times but also below its 5 years average, where we understand how expensive or cheap the stock is. Next, let us look at the current market price with the book value. This compares the price with the book value of the stock. The book value is basically the value of the share as per the company. This is the price that the company says its stocks are worth or its shares are worth. And we compare this with the price that the market participants have given to the share. HDFC Bank was quoting 4.5 times higher than its book value or its actual value of the share. Kotak Mahindra was also very expensive at 5.7 times its book value. Here we want the price to book value to be less than 2.5 times. That is, whatever the company is saying its shares are worth, we don't want to buy those shares by paying more than 2.5 times. ICICI Bank was very nearby to 2.6 times its book value. Axis was also very nearby to 3.2. Yes Bank was trading at a discount. The market participants have discounted this share even below its actual book value. So here this creates an opportunity for investors where the current price of the share is below its book value. This does not automatically mean that investors should buy into this company. We have to look at all different ratios, almost 50 or more ratios, to understand how the company's different metrics are behaving. Next, let us look at the price to sales. That is, what was the company's price per share against the sales it did per share basis. Or we can consider it as a whole by comparing this year's sales against the total market cap of the company. So we don't want this ratio to go or exceed a certain number. Now there is no fixed number for price to sales, but we want it to be as near to 1 as possible. That is, the company's market cap is as near its total sales of this year. This is a very good metric to understand how the company's sales are increasing. HDFC's market cap or price per share is 6.8 times higher than what it did as total sales in 2019. So we want this to be as near as possible, which would suggest that we are paying as low a price for the company's sales. Kotak was trading even higher at 9.7 times its sales. Both ICICI and Axis were trading at just 3.9 and 3.8 times. Even this is high. Yes Bank was again trading at a discount, that is, its sales were more or its revenues were more than its market cap. Next, let us look at the profit growth of the companies. This is the compounded growth in profit over the last 5 years, and we'll also look at how the profit has been compounding over the last 3 years. These are the growth metrics which measures the growth in the company's profits. We want the growth in the profit of the company to exceed at least 10% on average over the years. HDFC and Kotak both were growing its profits at a very healthy rate of about 20%. Even in last 3 years, the growth rate was very high at the rate of 19% for HDFC and 26% for Kotak. ICICI and Axis Bank saw a fall in its profit from 5 years back and 3 years back as well. The 5 years fall in profit was at the rate of 4.3% for ICICI, and for Axis it was 5.5% drop. Here we don't want to see the profits falling from where it was 5 years back. In the last 3 years, the fall in the profit is more at the rate of 14% and 17%. In Yes Bank, the 5 years growth in profit was just 1.2%, but in the recent 3 years the fall is 12.2%. So all these three banks, ICICI, Axis and Yes Bank, have seen their profits fall from where they were 5 and 3 years back. Next, we'll look at the PEG ratios of the last 5 years and the PEG ratio of last 3 years. PEG is basically dividing the price to earnings or PE ratio with the profit growth rate. This ratio then helps us to understand whatever price earning we have paid for the company's shares, are we getting a growth in its earnings? So if we are getting the growth, then we'll be able to recover the price paid for those earnings faster. We want these ratios to be between 0 and 1.5. Many investors want it to be even below 1 times, or at least 1 time, or below 1 times and above 0. So then when the ratio of PEG is between 0 and 1 times or 1.5 times, it would generally indicate that whatever price earning we have paid for the company's shares is justified. And as I mentioned earlier, price PEG is calculated by dividing the price earning of the recent 12 months with the profit growth rate of the last 5 years and the profit growth rate of the last 3 years. So we have a PEG of 1.6, which is slightly above our criteria of 1.5. Kotak's PEG is 1.7 and 1.5. So even if the price earning is 40 and 31, it is still justified because the profits are also growing at a similar pace. So therefore we have a PEG of less than 1.5, although these are slightly above 1.5. ICICI saw a negative PEG for both 5 and 3 years. Similar was the case for Axis Bank. The negative value came because there was a fall in profit from 5 years and 3 years. This is not a loss but a drop in profit, and the rate of drop was 4% and 14%. So here, although we are paying 66 times or even 44 times, regardless, these are very expensive price earning. We would not want to buy into these companies at this price earning. But even if we do pay 66 times its earnings or 44 times its earnings, we will not be able to recover our initial capital within 66 years or 44 years because there is no growth in earnings. In fact, there is a fall in the earnings of the trailing 5 years or profit of the trailing 3 years. So we have a negative PEG. We don't want to see as investors, when we buy into a company using price earning, to see a negative PEG ratio. Yes Bank's PEG for the last 5 years has turned bad at 9.6 times, and even for the recent 3 years it has turned negative at 1 times. So here we see that although we are paying 11 times, we are not getting the growth because the growth is just 1.2%. So this will indicate that we are not, even this 11 times price earning is not justified. We want it to fall further for us to buy into this company, because the growth in the company's profit is not there. So that does not justify the price earning that we are paying for this company. Although most of the banks are calculated using the book value as the basis for entry, for the book value, Yes Bank is trading at a discount to other banks. Next, let us look at how the company has grown its sales over a period of 5 years and over a period of 3 years. So this is the compounded sales growth of the company over the last 5 years and over the last 3 years. This helps us understand how the company's revenues through sales are increasing or decreasing. Generally, we would want to see, like in profits, the sales too should be growing at least 10% every year. On average, HDFC's sales or revenue coming into the company has been growing at a very high pace of 19% and 18% in both 5 years and 3 years. This is the rate at which we would want to see the company's sales growing as well as profit growing. These are very high growth rates for the company. Even Kotak has grown its sales at a very high growth rate of 18 and 23%. ICICI sales is slightly lower than 10%. In 5 years, it was growing its sales at 6.7%. And if we look at the profit growth rate at the same time, we see although their sales was growing in 5 years, their profits were dropping at the rate of 4.3%. And the sales was growing at 4.2%, but the profit was falling at the rate of 14%. So here we want both the sales growing as well as profits growing. So when the sale is growing and the profit is decreasing, it means there's some problem in the company, or there are some issues which needs to be looked into. Axis Bank also saw a double-digit growth in its sales of 12% and 10%. The same didn't get reflected in its profit. In fact, the profit has been falling at the rate of 5% and 17%. Yes Bank's, although profit has been falling or is growing at a very nominal rate, the sales were growing at a phenomenal growth rate of 24% and 29%. In fact, in the last 3 years, the sales growing or the revenues coming into the company was growing at a very high rate of 29%. So these are good values for Yes Bank, where the sales, which is a critical metric to look at. Next, let us look at the return on equity. This is the average return over the last 5 years that the company has earned on the equity shareholders' money or on the shareholders' money. Return on equity helps us understand how efficiently the company is earning profits on money contributed by the shareholders. So on an average, HDFC has been earning 17% on shareholders' money. Here we want the ratio or the returns of at least 15% and above. The only other company which has earned more than 15% is Yes Bank on the shareholders' contribution, and Kotak, ICICI and Axis Bank have fallen short of 15%. Last year, or the latest 2019 RoE, HDFC has earned again 16%, although from the average it has fallen. Kotak is again at the same rate as it was in the last 5 years on average. ICICI's recent ROE has fallen below its average of 5 years. Same is the case for Axis Bank and Yes Bank. Yes Bank's ROE has fallen from 15% on average to 6.5%. Let us look at the growth in ROE over a period of 5 years. Here we are trying to understand how the ROE is growing from 5 years back. HDFC's ROE has been falling at the rate of 5% from 5 years back, and most of these companies' return on equity has been falling. Highest fall in ROE was seen of Yes Bank, where we already seen here that the last year it had the lowest ROE of 6.5%. Next, let us look at the return on capital employed. This is the average return over a period of 5 years on the total capital employed. Let us also understand what is capital employed and what is the return or what is the profitability in this case. Here, profit is considered as the EBIT or earnings before interest and tax. So we are also adding depreciation in this, and then we divide that by the average capital employed over the last 5 years. Now this capital is that we are considering here is made up of fixed assets of the company and any working capital that the company has deployed into the business. Working capital is calculated by removing the current liabilities from the current assets. So in short, what we are doing here is we are taking fixed assets, we are also adding current assets to that, and we are removing current liabilities from it. So what we get is the total capital employed into the business. So over a period of last 5 years, HDFC's returns or profits were 7.7%. Now for the banks, the return ratios are little less because their capital employed into the business is very high, because most of these banks work on leverage, and because of which the return ratios would generally fall. So here we want it to be as high as possible. Otherwise also we would want it to be above 15% for companies which are into manufacturing. So over a period of last 5 years, RoCE for the HDFC Bank was 7.7%. The highest return on the capital employed was by Kotak Mahindra at 8.8%, and so on for the other companies. The recent RoCE or the latest RoCE, HDFC Bank's current RoCE is below its average. So is with Kotak Mahindra Banks, whose recent ROE has fallen below its average, and most of the companies' recent ROE has fallen below its 5 years average. You would want to see the current RoCE to be above the average, which would signify some strength in the company's growth in RoCE. Next, let us look at return on assets. This is the average profit that the company has earned on the assets over a period of last 5 years. Assets are composed of or is calculated by adding all assets, that is the total assets of the company, and you reduce the current liabilities. So all these RoCE, RoA and RoIC are basically very nearby to each other, and they measure the profit against different variables from the balance sheet. So in this case, here we are taking up the total assets. In the RoCE, we took only the fixed assets. Here we are taking all assets and we are just removing out the current liabilities. So when we are doing that, we are in the previous RoCE, we had also added the current assets to that, but in total assets, current assets are already added. Over and above that, we are also adding all other assets to that. If this is a little confusing, you can search out on the websites about RoA, RoCE and ROIC. These are very important metrics which are important to look at, because most investors would give a high ranking to companies which earn high profits against the capital employed into the business. So this ROA over an average 5 years period, we want it to be as high as possible. Here too, there is no fixed number or percentage that we can look at as a benchmark. The HDFC Bank has earned an ROA of 1.9%. As I mentioned earlier, most of these banks work on leverage, so their return ratios, return on assets especially, would be very low, because the assets are huge, or the asset would basically mean the balance sheet size of the company, total assets. So that is almost 5 times, 6 times, or 10 times on leverage. The debt is almost 5-6 times higher than its equity contribution. So here we want it to be as high as possible. The highest growth or highest percentage was seen in Kotak, earning a return of 2.1% on its assets deployed into the business. Next, let us look at the asset turnover. This ratio measures how the assets were turned over into profits or into sales, for that matter. So here what we are doing is we are taking the annual sales value and we are dividing it by the annual assets, so which would generally signify to us how many times more the assets were converted into sales. So here the assets would mean net worth plus the borrowings of the company. So in all these ratios we have different variables, and we are comparing it either against the net profit of the company, or against the sales, or against the EBIT of the company. So here we want it to be as high as possible, but for banks, as I mentioned earlier, since they have a very high asset base, it would generally translate into a low turnover and low ROA. So most of these banks are at a similar asset turnover of 0.1. In return on capital employed or invested capital, return on invested capital is calculated by taking operating profit. Now this operating profit is basically excluding depreciation and excluding interest cost as well as taxes. This is not the EBIT that we referred to earlier, and then we divide that operating profit with the invested capital. In this case, invested capital is the net worth plus the working capital. Working capital, as I explained earlier, is the current assets plus the removing out the current liabilities from it. And net block is basically the fixed assets that the company owns, but that is after deducting the depreciation from that. HDFC's return on invested capital, that is on net assets plus the working capital, is very high at 83%. Most of these banks would have a high ROIC because the base or the denominator in this case very low. So because that would only consider the net block, most of these banks don't have huge asset base or fixed assets for their working. And even their working, although their working capital may be high, but when we remove the current liabilities from current assets, the overall denominator of this particular ratio becomes small. Therefore, we will get a very high ROIC values for banks. Kotak Mahindra's ROIC was 32%. ICICI had a loss last year. They had a negative 8.6% of ROIC. Both Axis and Yes Bank have generated a high ROIC of 28% and 56%. Next, let us look at the profit values and compare that against the previous year's profit, and then also compare the profit with the cash that the company has earned over the last 5 years. The average profit that the company has earned over a period of last 5 years was 15,124 CR for HDFC Bank. This is the profit that the company has shown on average in the last 5 years. Against that, the current year's profit was 21,000 CR, which is above the 5 years average by 39%. So here we want to see a growth in profit above the average, which signifies that the company's profits are growing at a healthy rate and above the average. Kotak Mahindra's current year's profit has also grown at 68% above its 5 years average. But all the other three companies, like ICICI, Axis and Yes Bank, saw a fall in their current year's profit against the average. ICICI saw the highest drop in its profit by 58% below its average. On an average, it was earning 10,000 CR, whereas in the recent year, it has earned 4254 CR. When we look at the growth over the previous year, that is how the profit has grown from the preceding year. Now, this profit values excludes the extraordinary items that the company had either incurred as expenses or gained as income. So this profit after tax values does not consider the extraordinary items. So you will find a variation from other websites if you look at the profit values. So take this into consideration. So YOY growth in profit from its previous year, HDFC has seen a 20% growth rate, that is from 17,000 in the previous year to 21,000 in the latest year. There was a growth rate of 20% in profit. We would want to see a growth rate of at least 10% on average. Kotak's profit also grew at 9.4% YOY, that is from its previous year. ICICI and Yes Bank has seen their profits falling by 44% and 59% from the previous year. In the previous year, Yes Bank had earned 4,200 CR against the current year's profit of just 1,720 CR. Let us next analyze the quarterly sales growth rate and quarterly profit growth rate. Here we are looking at YOY comparison and QOQ comparison as well. So let us see how the sales have grown over its previous year's quarter. HDFC has grown its sales at 23% and all other banks have also grown at a double digit, which is a good sign for these companies. In terms of growth in sales over its previous quarter, HDFC Bank has grown by 1.7%. Kotak's sales has increased by 3% from its previous quarter. Even Axis has managed to gain 4.7%. For both ICICI and Yes Bank, they have seen a fall in their sales from its previous quarter. In terms of profit growth rate, YOY, all of these companies have gained profits. Axis Bank's profit over its previous quarter has gained 168%, but this value or any value about 20 or 25% has to be looked into, because these growth rates are because the base year profit value must be very low compared to this quarter. So whenever we see this exceptional gain, we should not give it a high ranking. At the end of this video, I'll be ranking all of these ratios to understand which of these companies are good compared to the peer group. Yes Bank saw a drop in its profit from its previous year by 227%. Even in terms of QOQ profit, that is from its previous year, we saw only Kotak and HDFC gaining in terms of profit from its previous quarter. Rest, all the three other banks, Axis, ICICI and Yes Bank, have seen their profits dropping by 37%, 10% and 250%. So Yes Bank has seen the maximum fall in its profits. Next, let us look at the net worth of the company. This is the size of the company after it clears off all its liabilities. So net worth is basically company's total book value for all shares, and it is calculated by removing all liabilities of the companies by selling all current assets, or all assets in fact for that matter, and what remains is the net worth, or the value, or the money that the company is holding, and which will eventually be distributed to the shareholders of the company. So that's the net worth of the company, or the actual value of the company, compared to the market cap, which considers the value given to the company's shares by the market participants or investors in the market. So we see here, most of these companies are large cap companies having their net worth. HDFC has a net worth of 1,49,000 CR, and ICICI too is above 1 lakh CR. Kotak Mahindra and Axis are 66,000 and 50,000 CR companies, whereas Yes Bank is a mid cap of 26,904 CR. Next, we'll look at the contingent liability that these companies are holding and compare it against the net worth of the company. Now, for most of these companies or banks, they would have a very high contingent liability. But for normal companies, we don't want the contingent liability to exceed 20% of the net worth. HDFC's contingent liability is 1,07,000. In fact, it is 10,74,000 CR, which is almost 10 times more than its net worth. So we see here, it is 7.2 times more than its net worth, or 720% more than its net worth. So we want these ratios to be as low as possible. Kotak Mahindra's contingent liability is just 4.6 times its net worth. All the other three, ICICI, Axis and Yes Bank, have their contingent liability above double digit, 17 times for ICICI Bank, 12 times for Axis and 24 times for Yes Bank. So this is not a very good sign for Yes Bank, where its contingent liability has exceeded its net worth by 24 times, which is the highest in the group. Next, let us look at the debt to equity ratio. This is the total debt the company has raised from the market or from the banks against the funds received from the equity shareholders. We don't want the debt to equity ratio to exceed 1 times. But for banks, it would generally be very high, because these companies are into financing business. They have to borrow a very high multiple of the money raised through the equity shareholders. Most of these banks have above 5 times debt to equity ratio. That is, their borrowings are more than 5 times the money contributed by the shareholders of the company. The lower the better for the banks. HDFC Bank's debt or borrowings was 7 times its equity contribution, and other banks too, like Kotak and ICICI Bank, were in single digit. Axis had a 10 times more debt or borrowings against its equity contribution, and Yes Bank had the highest debt to equity ratio of 12.5 times. And when the banks have a very high debt against the equity, that would eventually reduce the coverage or the interest coverage that the company would have. The interest coverage is basically calculated by calculating the EBIT or the earnings before interest and tax and dividing that by the interest payment itself. So what we get here is the coverage that the company can pay the interest over how many years. In other words, for how many more years can the current EBIT cover the future interest cost. So we want this to be more than 1.5 times for the banks at least. Even above 1 times is good for banks. Anything below 1 times means that the company's current EBIT cannot pay the future 1 year's interest cost. HDFC's current earnings before interest and tax can pay next year and a half interest cost. Same is for Kotak Mahindra Bank at 1.7 times or 1.7 years. Or we can also see it in another way. 1.7 times means that the company's EBIT is 1.7 times higher than the company's interest payments. ICICI Bank and Axis had both 1.2. EBIT was 1.2 times higher than its interest cost. Yes Bank's EBIT was very near to its interest cost of this year. So we want this to be as high as possible. For other normal companies or companies which are into manufacturing and trading, their coverage should be at least 4 times. That is, their EBIT should be 4 times higher than what they pay in the interest cost. Most of these companies or banks would have a very high interest cost because they are borrowing at 7 times or 5 times, and for Yes Bank 12 times. So when the company starts borrowing very high, their coverage would of course fall. Next, let us look at the debt to profit. This ratio helps us understand how much debt the company is carrying against the profit that the company has earned this year, or how high the debt is compared to current year's profit. Here we want it to be as low as possible. That is, debt should not be very high compared to the profit that the company is earning. In other words, we can also see it in this way. In how many more years can the company's current year profit pay off all its borrowings or debt? So we can either see this in terms of years that the company's profit can pay off the debt, or we can see the ratio between the two, or how high the debt is compared to the profit. HDFC's bank's profit was, or the debt, the borrowing was 49 times higher than this year's profit. Most of these banks' profits or borrowings are very high compared to the profit it is earning. So if HDFC Bank has to clear all its borrowings or debt, it will take it 49 years with current year's profit to clear off that debt. Kotak Mahindra's borrowings were 40 times higher than this year's profit. ICICI would take 105 years to clear off its borrowings with this year's profit. Axis Bank and Yes Bank had a very high borrowings compared to their profits. Of course, this ratio will change each year depending on how much profit the company is earning and how much debt they have reduced or increased in that particular year. But in this year of 2019, we see Yes Bank's borrowings are very high compared to its profit. It will take it 195 years just to clear off its borrowings if the current year's profit remains constant. So as I mentioned earlier, the debt to profit ratio should be as low as possible. Promoter holding. This is the holding that is there by the promoters of the company. We want this holding to be more than 20% for the banks. Generally, banks' promoters cannot hold more than 20% as per the guidelines or the rules of SEBI and RBI. Most of these banks were very nearby to their holding or of 20%. Kotak Mahindra Bank had a 30% promoter holding, which they would eventually have to reduce it to 20. None of these companies have pledged any of their shares with financial banks. It is important to have the pledged share as low as possible and not exceed 20% of the promoter holding. Yes Bank had a minor pledge of 3.6%. Let us look at the 5 years operating profit margin that the company is earning over a period of 5 years. We want this ratio to be above 15% for trading company, but for banks, since they don't have any operating expenses as such, their OPMs would be very high. So then we have to look at the NPM figure as well and see if it is above 10% at least. HDFC Bank's OPM was high at 67%, and most of these banks had a very high OPM margin, except for Yes Bank's 5-year average OPM was 9.2%. Now this needs to be investigated why ICICI's OPM is so low. Let us look at the latest NPM margin that the company has earned on the sales or revenue it has generated. HDFC Bank's NPM was 21%, followed by Kotak Mahindra at 24%. We want the NPM to be at least 10% and above. ICICI also managed a 12% NPM margin in the latest year. Axis Bank and Yes Bank have fallen below 10% each. In the previous year to that, HDFC's NPM was again 21.8%, Kotak's was 22%, and the latest year it has even grown it 2 points above the previous year. ICICI Bank's current NPM has fallen below its previous year of 16%. Axis Bank in the previous year had 0.6% of NPM, whereas in the latest year it has increased to 8.5%. So they have managed to gain further. Yes Bank's NPM, current year's NPM, has fallen below its last year's NPM of 20%. So there is definitely a problem with the NPM of Yes Bank in the latest year. Next, let us look at the current ratio. This is the ratio which measures how liquid the company is or how quickly can it pay off its current liabilities using the current asset it holds. Most of these banks had a good current asset to current liability ratios. The highest was seen in Axis Bank. It had 3.8 times more assets than it had liabilities to pay off. Let us look at the total assets the company owns and the accumulated depreciation on it. Then we'll look at the net block, that is the net assets that the company owns after the gross block has been depreciated, and what is the depreciation it has been charging on this net block. So companies, HDFC Bank had 12,346 CR of assets with it. This is the fixed assets, tangible as well as intangible, and the accumulated depreciation is almost 67%. So most of these assets are already depreciated by 67%. So it has only 8,316 CR of fixed assets left to be depreciated further. So this would eventually, in the coming years, if they don't add up more assets, then as they just have another 33% to go, it would eventually add up into the profits of the future years. In terms of net block to depreciation of the current year, we see the company is depreciating its assets at the rate of 28% every year, which is a very high rate. So as soon as their depreciation is over, that would automatically inflate the profit of the future years. So we want the depreciation rate to be above at least 25 times or or say above 10 times, so that over a period of 10 years they can pay off all their they can clear off all their fixed assets using the depreciation charge. Also, in terms of accumulated depreciation, we want maximum of its gross block to be already depreciated. So in the future years, then the depreciation is less, and that adds up into the profit of the company. Most of these companies' assets have already been depreciated at above 50% on average for all companies. And these companies are charging depreciation rate of above 15% at least for all companies except ICICI, which is depreciating its assets at a very low rate of 9.7%. Now, when the company starts depreciating at such low rates, it means that they are trying to inflate the profit. The lower the depreciation rate, the higher the profit. Finally, let us look at how much dividend the company is paying on the share price of the company. Most of these companies are paying very low dividend yield, and none of these companies have exceeded 1% except Yes Banks. Because of the price, the dividend yield has increased, or the drop in the price, the dividend yield has increased by 2.3%. So if the company keeps paying the dividend that it paid last year, using the current price, we can expect a 2.3% of dividend payout or dividend yield. Now, we have concluded the analysis of these banks. Let me give it a ranking and then we will continue the analysis. So now I have color coded all the companies. The green represents the best score, the blue represents the second highest score, and the red one indicates very poor score for that particular ratio. So in this way, I have ranked all of the companies, and after ranking I see that HDFC has got 150 points, which is the highest. After that, Kotak Mahindra has got 142 points, followed by Yes Bank at 118 points. Now these points are based on the ratios that we saw earlier, and these are of different categories: efficiency ratios, solvency ratios, growth ratios, return ratios, that is profitability ratios, and valuation metrics. After giving this score and dividing all these ratios into these basic 5 metrics, what we see is HDFC Bank has got the highest score. Now let me recap all of these ratios quickly. The lowest fall was seen in HDFC Bank and ICICI Bank, and the highest fall was seen in Yes Bank and Axis Bank from its 52 weeks high. Next, earnings yield was highest for Yes Bank at 8.4% because the price had fallen quite high at 78%. Therefore, the earnings yield also had increased to 8.4%, followed by HDFC, which had an earnings yield of 3.1%. The poor earning yield was by ICICI at 1.5% and Axis at just 2.3%. In terms of recent price earning of the latest 12 months, we saw Yes Bank was the cheapest stock available in terms of earnings, followed by HDFC at 31 times. The other 3 companies were very expensive. ICICI was the most expensive, followed by Axis Bank. In terms of 5 years historical PE and 3 years historical price earning also, we see that ICICI was the least, at the least price earning multiples, followed by followed by Yes Bank. The most expensive was Axis Bank, trading at triple digits price earning, followed by Kotak Mahindra at above 30 times. In terms of book value, Yes Bank is trading at a discount to its book value, and ICICI Bank was the cheapest stock as far as price to book value is concerned at 2.6. Although this is also high because our benchmark is 2.5 times. The most expensive in terms of book value was HDFC and Kotak, available at 4.5 and 5.7 times its book value. In terms of comparing price against the sales, both HDFC and Kotak were quite high, that is, price was quite high compared to its sales. Kotak's price to sales was the highest at 9.7 times, and Yes Bank was available at a discount to its sales. Axis Bank too was quite low at 3.8 times its sales. In terms of profit growth, the highest profit growth was seen in last 5 years in Kotak and HDFC, and the maximum fall in profit was of ICICI and Axis Bank. In 3 years, that is in the latest 3 years, HDFC and Kotak again managed a very high growth in increasing their profits. Again, both ICICI and Axis saw a decrease in the growth rate of their profits. In fact, the profit has fallen at the rate of 14% for ICICI and 17% for Yes Bank. The PEGs, that is the price earning to growth ratio, which helps us understand the price earning multiple we have paid, is that justified. We saw that HDFC and Kotak both had a very good price earning growth rates. In 5 years, we saw ICICI had the worst PEG ratio, that is whatever price earning the investors were paying, that was way too high even at this level. PEG 5 years for Axis Bank was also not very good, and PEG 3 years was not good for both Axis and Yes Bank. In terms of sales growth, highest sales growth was seen, or revenue generation was seen, in Yes Bank over a period of 5 years and 3 years, followed by Kotak. In 3 years, the sales has grown at a phenomenal 23%, and even in 5 years, HDFC has done best at 19%. The sales for Axis and ICICI was not that good compared to the peer group companies. In terms of giving a return on equity, the best return was by HDFC for both average 5 years and single year. Kotak also managed a good RoE of 13% because the other group companies were very low. Axis and ICICI both had a 7.2% of RoE in the latest year. RoE growth rate over a period of 5 years, the least fall in RoE was seen in both Kotak and HDFC, whereas the other group companies' RoE has been falling from 5 years back at a double digit. RoCE 5 years average was seen best for Kotak and Yes Bank. They have earned a profit compared to its capital employed at 8.8% and 7.8%. Even HDFC was very nearby to 7.7%. Both ICICI and Axis were poor at earning returns on the capital employed into the business. Latest year RoCE also was poor for both ICICI and Axis Bank, and HDFC and Kotak have seen a high single digit RoCE percentage. In terms of return on assets, again HDFC and Kotak have done the best, whereas ICICI and Axis have done poor. In turning over assets, most of these companies had the same turnover in their assets. That is, how much was the sales against the net worth of the company, plus the borrowings employed into the business. ROIC was seen best for HDFC and Yes Bank, and Axis and ICICI had a poor growth rate in their ROIC, rather the return on their invested capital. HDFC and both Kotak managed to grow their current year's profit at a high pace above its 5 years average, whereas both ICICI and Yes Bank saw a fall below its 5 years average. That is, the profit had fallen at 58% below the average and 37% for Yes Bank below the average of 5 years. In terms of growth rate over the previous year, the profits for both Kotak and HDFC have grown at 20% and 9%, and both ICICI and Yes Bank saw a fall over their previous year's profit. ICICI's profit fell 44%, whereas Yes Bank's profit has fallen 59% from its previous year. In terms of quarterly sales growth rate and profit growth rate, we saw that Kotak and HDFC have done well in increasing their sales as well as profit in the recent quarters. ICICI has done poor. Their sales have not grown at that high pace. And even their profits have fallen from their previous quarter and previous year's quarter as well. Even Yes Bank has done poorly in the recent quarter. Their profits have fallen the most from both YOY and QOQ. In terms of contingent liability, the lowest contingent liability was seen in HDFC at 7.2 times its net worth and 4.6 times for Kotak. Kotak had the lowest contingent liability of 4.6 times, whereas Yes Bank had the highest contingent liability of 24 times, followed by ICICI Bank at 17 times. So very high contingent liabilities. The debt to equity, again, the lowest debts was seen in Kotak. They had just borrowed 5 times more than their equity. Therefore, they also had a very good coverage, as well as the lowest debt to profit ratio, followed by HDFC, which also saw a similar kind of return debt to equity ratio, coverage ratio, and debt to profit ratios. Yes Bank has done very poorly in terms of its contingent liability being very high. Its debt is 12 times its equity contribution. Its coverage is the lowest, and its profit will take 195 years to cover the borrowings that it has taken, followed by Axis Bank as well, which had a debt of 10.5 times its equity and a low coverage of 1.2. And it would take 150 years to pay off its borrowings using this year's profit. Most of this promoter holding was around 20% for these companies. 5 years OPM was best seen for Yes Bank and HDFC, and the lowest OPM was for Kotak and ICICI. ICICI had the lowest OPM of 9.2%, which again needs to be investigated. In terms of net profit margin of the latest year, both Kotak and HDFC have earned 20% and above, and the lowest NPM was seen in Axis and Yes Bank. Yes Bank had a low NPM of 5.8%. In terms of previous year's NPM, again, HDFC and Kotak have managed the highest double-digit NPM of over 20%, and the least profit margin was for Axis and ICICI in the previous year. In terms of current ratio, or how quickly the company can pay off its current liabilities using the current assets, we saw ICICI and Axis both had a very good coverage, and HDFC and Kotak had a low coverage. Although this too is good, 2.4 times and 2.6 times is still good, but in terms of peer group comparison, this is low. Finally, we saw that HDFC was depreciating its assets, or total gross block, at its accumulated depreciation was 67%, which is a good sign, because now only 33% is still left over for depreciation, and that depreciation is also very high at 28% every year. Yes Bank too had already depreciated 58% of its assets, and on its net asset it was depreciating it by 39%, a very high percentage depreciation rate that of course reduces the profit that the company shows in its profit and loss account. ICICI was depreciating at a very low rate of 9.7%, although 46% of its assets have already been depreciated total, but annually it is depreciating at a very low rate. Therefore, its profits are likely to show high. As far as dividend yield is concerned, Yes Bank has paid the highest dividend yield, or would generate a high dividend yield of 2.3%. This is because the price has fallen considerably over the last 1 year against the dividend it paid last year. So what has happened is, basically we are comparing the dividend the company paid last year against the current price. So the maximum fall was seen in Yes Bank at almost 70%, because of which the yield has increased. So if currently any investors buy into this company, and if we expect the same dividend that the company paid last year, we can expect an yield of 2.3%. HDFC, as with the current price, is giving a dividend yield of 0.6%. Axis didn't pay any dividend. So this concludes our analysis. Let us look at these ratios that we just studied, and what I'll be doing is I'll be categorizing them into different metrics. We have 5 metrics: efficiency, solvency, growth, return. Return is the profitability ratio, and the valuation metrics. The efficiency ratio measures how efficiently the company is managing its resources that it has. For example, how well it is managing its depreciation on its net block and gross block. How much of the gross block has been completely depreciated till now. There are other comparisons as well, like what is the pledge of the company, and what is the contingent liability, how well it is managing its contingent liability, how well it is managing its debt against the equity, how well its coverages are regarding the finance cost. Then how fast can the company pay off its debt using current year's profit. Then promoter holding, how much stake the promoters have in the company. These are all efficiency ratio. Then we are going to look at solvency ratios, which that would measure how quickly the company can pay off its current liabilities using the current assets and so on. The growth ratio measures how quickly or how fast the company is growing its sales and profit over a period of 5 years or even 1 year YOY, as well as the quarterly growth rates in profit and sales. The profitability ratio or return ratios measures what is the profit that the company is earning against different variables like shareholders' money, capital employed, assets, and so on. And finally, valuation metric helps us understand where the price is compared to its earnings, or compared to its book value or net worth, or even compared to its sales, and so on. So I have categorized all of these 65 ratios into 5 basic metrics. Here I have arranged these metrics in order of their importance. I find efficiency metric as most important and the price metric as the least important. HDFC and Kotak have done the best in terms of managing efficiently the different key variables of the company. In terms of solvent, we see all these companies are quite solvent and there's no issues in these companies. The fastest growth or the highest growth was seen in HDFC and Kotak, followed by Yes Bank. In terms of profitability also, HDFC and Kotak have done best, and followed by Yes Bank at 3 points. In terms of price, we see the best price earning valuation, or all different valuation where the price is compared to different metrics. Both HDFC and Kotak are very nearby or almost at the same point, followed by ICICI. This concludes the final analysis of these banks. Thank you for watching this video.